my name is Caio Kinan and I create this system AI Stock Valuations. The reasons I create this website is because some books from Warren Buffett recommends to read many financial reports. The difficult part about reading financial reports because you spend a lot of time doing that, and many times the companies are not so good as you thought before reading them. So I decided to create a system to analyze the financial report faster than a human being. So it will be quicker and easier to analyze the numbers. That was the main first reason. The second reason is because I would like to invest only in good companies. I have lost some money in 2002 in the internet boom. So at this moment, I would like to invest only in good companies, but good companies with good financial numbers, right? That's the idea. And also find stocks which are underestimating, right, with good prices, right? Sometimes at this moment the market is really, I think, expensive, but it's still possible to find good stocks with good price. And my methodology is to buy stocks and hold for more than 3 years. So you have to really analyze the company, check the numbers. And in this video, I'm going to show you a little bit how I analyze it. This system was created based on many books from Warren Buffett. I have been reading the last 15 years. And based on his methodology, I create this system to find good companies. That's the idea, right? To find good companies, to validate ideas. For example, if I wanted to buy one company, I want to go here and check first if the company has a good number. Let me show you a little bit about that. So go to the website here. There are two domains. The domain.com, it's where you buy your subscription. You become a member on this here. There are two types of membership, the monthly and the annual. And the aistockbond.info is where you really check the information. So you can go here and join, but I'll go here to my account. I have here my account here. So under my account, I can go and check one company. If you have a free account, you can check 3 stocks and put one stock in your watch list. I have unlimited here, so let me check, for example, Apple. So you see here, fastly, I can see here some parameters. Fast parameters is easy to read. It's not some like some websites where it's pretty difficult to read information. It's pretty straightforward. I'll explain each of these numbers here. And you also have this report, right, which give you some indication about the company, some parameters. They give you some reports saying, for example, this company, Apple, did not grow her earnings in the last years. So in the last 5 years, just 3 years, it has a growing in its earnings. So that's one point. And here you have the report. But I'll go one by one. The reason of this video is to explain one by one of these parameters so you can read them. Also, there is access here if you want more information about the company. You can go here to Yahoo Finance, right, and check news and all the everything Yahoo Finance provides, right? So let's go back for the presentation. So as I mentioned here, the idea is to analyze the company as if I was going to buy the whole company, not just a share, right? If you are going to invest your money, it's like if you're going to buy the whole company. So you want really good numbers. You don't want to buy a company with weak numbers, right? We are just analyzing companies here with 5 years of public financial numbers, right? Why? Because I want to have some history, historical data to really understand if the companies are good. I don't want to invest in companies who are just starting the market. I know sometimes they give a good return, but that's not our focus, right? The other important part is because our system is a support tool and it's going to help you to have a better decision. Okay, so we don't make recommendations, but we are showing you some numbers, and based on these numbers, you decide if you want to buy, if you want to hold, if you want not to buy based on these numbers. I'll explain what I do, and you see how I do it, and you may use our system to do the same thing, right? So as I mentioned, why I use the system? First, to validate a stock purchase idea. Okay, so for example, I go here to the website and I wanted to buy Amazon. So I go here, insert the stock symbol, and I have here some numbers from Amazon. Grow consistent, right? It has grown in the last 5 years, 4 years, so it's good. But the earning variance is here maybe too high. So based on this number, I decide if I want to buy or not. Also, I use the system to check if I need to make further investigations. For example, let's check here one stock, AT&T. Here, I found some numbers here. Research and development revenues ratio and research and development net income is zero. So zero. Uh, it sounds strange. So I decide if I want to go and research further about this number here, right? Or I want to check, for example, confirm if the net income total abilities are just 7 years. If they are 7 years, looks strange for me, too many years. So I also want before buying, I go and double check that and understand the reasons behind this number here. Okay, and also if I have a stock, I want to check if the financial numbers are still strong, because if the financial numbers are becoming weak, maybe it's time to sell the company, right? Because in the future, maybe it's not going to give the return, or the price is going to decrease. So that's why, that's the reasons, the main reasons I use the system to validate idea I have, to check the numbers in an easy way, easy and quick way, and to see if I don't need to do further investigations, right? And also, if I have a stock, I want to check if the stock is not having weak numbers, and maybe it's time to sell the stock, right? Okay, which advice we follow here? First thing from Steve Jobs, when he talks about focus and simplicity. So we try to simplify as much as possible things, because we see many websites on the internet. They are pretty complex and hard to deal with, right? And also we follow here the advice from Warren Buffett, where the stock market is transfer money from people, impatient people, to people with who are patient, right? So that's the idea here. Be patient, find good companies, right? And simplify things and make these easy to understand. To do that, we use 18 parameters here. Okay. The first impression, they might look uh, uh, strange, so might be too many, right? But when you go one by one, you see they are pretty simple and pretty straightforward. Everything based on Warren Buffett theory. First thing here, first thing first. So what you want to know if the company is growing every year, year after year. So if the company is growing year after year, it's because it looks like a good company. So year after year, it's growing a little bit. So it has strong numbers based on that. It's growing. For example, if you want to buy a store, you don't want to buy a store which is growing just 2 years. You want the growth in earnings, grow year after year. That's the first signal I analyze. The second important point here, it has low variance on the growings, on the earnings, right? You don't want to buy a roller coaster, a company which you have the feeling you are in a roller coaster, right? You want to have good predictable. You want to have earnings which are predictable and low variance, right? It's growing. The earnings are growing 30% in variance. So you don't want to have high variance. 1 year it grows 100%, the other year just 5%, the other year 20%. So you want to have more consistency, right? Grow 10, 20, 30, and it grows consistently every year. So you also want to check in the last 5 years the earnings per share growth rate, right? So it means it's fast or it's slow. Usually higher than 12% are good, right? Lower than 12%, which is the US average, it's not so good. It's slow growth, right? But you also have to pay attention in miracles. So one company is growing 100% per year, the earnings in the last 5 years, it looks strange. Of course, some companies have done it, but it looks strange. So you want to be realistic on that. So usually higher than 12% is nice. 30%, I would say it's a good limit. Above 30%, you need to investigate more what's going on with the company. So up to now, this video, it's free. From now on, if you want to watch it, you just subscribe in our website, aistockvaluations.com. If you are already a member, so you have the full video and you can watch the video for the total of parameters. So let's move forward. If you have just, if the video stop here, it's because you need to subscribe to see the other valuations. Okay, the other point you like to check is also the initial rate of return. For example, what's the initial rate of return? Let's say you buy a house, okay, and you pay $500,000 on that house, and you rent for 50,000. After all your expenses with this house, you have 10% return. So you invest 50,000, you have 50,000. You invest 500,000, you receive 50,000. 10%. That's a good number. Usually 12% is better. 12% is the average. Okay. Let's say stock. You pay $100 per share. Okay. And you have the annual earnings of 5. So it's 5%. So what I like is around 12%, above 12%. If I invest 100, I would like to have $12 in earnings. Okay, that's the first parameter I use to see if the company has strong numbers. The fifth parameter I use, it's let's go back to the house. Let's say return on shareholder equities. Let's go back to house example. If I invest $500,000 in a house, I make 100,000 in payments, in down payment, and my annual rent minus mortgage 25,000. I have 25% of return in the investment I did. So I invest 100,000, 25,000 net profit. I have 25%. Looks good. So the number again, 12% is a good number. Below that number, it's hard to buy the company because maybe the company doesn't have a good return on shareholder equities. Let's have an example here, right? Let's go back to the website here and let's see one company here. Let's see Tesla. Okay, Tesla has minus 90% on shareholder equity, so doesn't look good, right? Let's go for Starbucks. You see Starbucks also some negative return here. Okay, but you see the growth consistency is good, the earning variation is good, the per share is good, but the initial rate of return not so good. That return on shareholder equities also doesn't look so good. So it's an indication here. Probably it's the price is above the nice price to buy, the fair price. That's an indication here. There are other indications. Let's go for Amazon, for example. It's taking a while to read. Amazon, the return on shareholder equity is 23%. You see, looks good. So Amazon is growing 4%. The earning variance here is too high. You see 400%. Per share growth rating 80%. It's good, maybe too good to be true, or maybe they had good business here in the past, but can they still do the same thing in the next year? That's a big question mark. Initial rate of return 1%. I don't like this. Looks like it's the price is above the fair price. Return on share record is good. As you can see, based on these parameters, you can start having some idea if the companies are good or not to buy. In our website for subscribers here, you have here the top financial fundamentals. So you see the top companies here. Okay, you see, for example, this company here, the earning variance is 40. Per share growth rate is 30%. Looks good. Initial rate of return 25%. Return on share equity 30%. You see the numbers, they are consistent and they look good. Let's go for the next one here. So return on shareholder equities. This is a nice KPI, right? Performance indicator. So if the company has an annual growth rate of 10%, you can project the future, right? So if the stock's not at 100%, to make a projection for the next 5 years, and you have the stock price would be 161. So you are looking to the past and projecting the future, right? Of course, the past does not reflect the future, but at least give you an indication. I like to have at least 80% gain in the last 5 years. So 80% is the number. I like it. Above 80% is good. Also, when you start reaching 300-400%, then I have to investigate more. Why this return is so high, right? That's something we need to pay attention. Again, miracles. It's hard to believe in miracles, right? Of course they happen, but I prefer to be conservative and go up to 300, 3 times the capital in 5 years. The other criteria I use here is the bond coupon percentage. So it means I compare the return based on the T-bond, the treasury bonds, the U.S. government bonds, right? If the U.S. government bonds is 2%, the annual coupon, I analyze with the stocks. If the stock is the same, 2%, I treat it as a stock. Let's say I buy $1,000 and it gives me just $20, 2%. Why would I buy a company? It's better to buy the treasury bond. It's safer. The U.S. government is going to pay. There are not so many risks, right? That's another parameter I use. And the earnings is above 6% is good, 4% higher than the U.S. bond. So you are making 3 times what we would make. The risk is 3 times better. The returns are 3 times better than the U.S. bonds. So you have 6%. Above 6% for me looks good. So you are comparing fixed income, financial instrument with stocks, right? To see if the returns are good. The other, that's common, price to earn ratios, right? How many years you need to recover your investment. Let's say you buy a stock of $50 and you have $5 back in earnings, right? So you take 10 years to receive your investment back. I think rational will be 5 to 8 years, right? Usually when you buy a company, they pay 5 to 8 years earnings on that. So, but these days, PAs of 5 to 8 are pretty rare, right? But that's what I'm looking for. Of course, sometimes I don't find what I'm looking for, but that's what I'm looking for. So let's go back to the website here, and you see here. Let's see here, for example, this company here, right? It's 41%, 30% per share growth rate, initial rate return 25, return on share equities 29, expected capital almost 300%. Everything looks good, right? Bond, nice. Price to earns ratio 3.0, looks good, but there's a problem here. If I go and access that company here, that's so we are analyzing numbers, right? But there's other parts you have to analyze too. This company here, it's an investment management manager, right? So it's a fund, right? The firm launches and manages equity, fixed income, and mutual funds. The problem with this type of companies is because it's people. Let's say they have 100 employees here. I don't know exactly numbers, but let's say they have 100 employees. Let's say they have the top 10 ones are the best ones. That's why they have so nice returns. Let's say they have this kind of fight. If you have watched the series Billion, you can see that where one of the top managers of the fund left to open his own firm, and then the company is in problem because most of the time here it's people. The value on this company here, the competitive advantage here, competitive advantage is how the company has these advantages over the competitors. And Warren Buffett mentioned durable competitive advantage is something durable, and this guy here is not so durable. So you see the numbers here. The numbers are pretty good up to here, but it's not a durable competitive advantage because people can leave, and then this you'll be in problem here because maybe the top people believe in the company to create another firm. So that's why I don't buy this company because of this reason, right? So let's go back here. The other important point here is how much money the company needs to invest to develop new products, right? And to keep his durable competitive advantage. If you are a car manufacturer, you have to invest billions to launch new cars, to create new cars. Think about BMW, Ferrari, all these players, right? Fiat, they need to invest a lot of money. It's different from a coffee shop chain, right? They don't need to invest a lot of money in research and development. So if you don't invest a lot of money in research and development, means you keep more money for yourself, right? And you keep more profits. Simple like that. And here you have these numbers. This company here, right? The other company here, for example, when I see zero here, I always do a further investigation. Why zero? Why this number is zero? Right? This company, they don't need to develop anything else to to keep their competitive advantage. The world today is too fast. So this company, are they invest anything? So that's something I always research more. Let's go for the another parameter. If I compare the research and development revenues ratio, right here, sorry, I'm comparing here and checking what's the percentage. So here it's saying this company, the net income, the profit, 25% of the profit, it's investing in new development, research and development. And the revenue, 5%. So looks good, right? This company here, for example, 60% of the profit in research and development. That looks not so good because look this one here. This one has to invest 160%. This 30% looks reasonable, right? I like something about 20%. So of the profit, it invests 20% of research and development to keep his durable competitive advantage. This other company here, uh, now I'm comparing the revenues, right? Let's say the total sales. Same thing. Imagine an airplane manufacturer, billions of dollars to launch a new airplane. Think about Boeing, Bombardier, Airbus, all of these big guys, and compare them with Starbucks, right? Of course, Starbucks doesn't need a lot of tons of dollars to research and develop new type of coffees, but Airbus, they need a lot of money to develop a new airplane. So that's type of, and I like the limit to 10%. If they spending more than 10% to research and development, maybe it's too high. Okay, let's go more here. So always, I like companies who are repurchasing stocks. Think about the following: you have a business, you have other three partners. It's a nice business, right? It gives you 25% profit. So 25% to each, 10%, 10,000 to each partner. Let's say I make 10,000, you make 10,000, and other two people make 10,000. So if the company goes and repurchases stock from one partner or from two partners, right? You and me will have 20% each without making extra investment. The company is rebuying the other partner's shares. So you and me, we will have 50% now. We have 25%, now we have 50%. So each one. So it's good business, right? Without making any extra investment, you are getting extra 25%. 30% is a good rate. I like 30% in repurchase stocks. And here you can see, let's go back here. You can see here, oh, look, this company is good. Let's see which company is that one. So we go here, we access the Gentex Corporation. So we can here go in the profile and see what's this company. You can read about them. So provides digital vision, and then you can go and research the company, right? But at least it's giving you some directions, right? It's giving you some directions, and as you can see here, they are rebuying their own stocks. So they are growing well, 5 years, earning variations not too high, per share growth rate 12%, above average initial rate of return, good, return on share, good, expected, good, bond coupon, good. You see, almost with all the numbers I'm looking for. This price here is indicating maybe it's too high, the price. You remember 5 to 8? Maybe I have to wait a little bit, like Warren Buffett said. Be patient, right? Be patient. They are researching and development 25%, which is a little bit above my limit is of 20. 5 is fine, and they are really buying back their stock. See, that's a good opportunity here. So what I do here, I add to my watch list this stock. I have here my watch list, and I'm going to pay attention on them. See, I found good numbers. I add to my watch list, and I'm going to pay attention to them. And I pay attention on this stock here. The same thing with revenues, right? I compare with revenues, the same history. 4 partners, if they are using part of their total sales and to buy stocks, again, you and me and more 2 partners. The companies make money and we buy, the company buys the other part. So instead of 25%, we have 50%. Our net profit for each partner was 10,000, now it's 20,000. So 20% is also good. Maybe too high here, maybe too high, but I like the idea, right? I like the idea to them to buy back stocks. And instead of having 4 partners, or 3 partners, now we have just 1, and then the profit for each one will be higher. Another thing I also check is net income total liability ratio, right? Think about you have a store, right? And the net income, the profit, is 10,000, and the total liability the company has is $100,000. It's 10 years of profits to pay the total liability. That's too high. You see here, liability, danger, risk, problem. So I will not trust in a company above 6 years of liabilities. Let's go back there and see. Net income total liability. Let's see this. You see this company here, almost zero. Just half a year. It means with half of the profit of 1 year, it pays its net total liability. Looks good, right? This company looks good. Okay, so that's why I create the system, right? This is a type of company I would research. I would read the annual report. I would go deeper on that. I would visit this company. I would talk with their suppliers. I would talk with their customers, right? Because you can read many books, you can read magazines, you can use many systems, but you have to walk on the street and talk with people, right? Because you need to validate some of, call the company, enter a conference, read magazines, but at least here gives you an indication where or which companies you want to invest your time, because this company looks good. So another ratio I use is the net income long-term debt ratios. Again, you have a store. That store has a net income profit of 10,000 per year, liabilities of 100,000, but long terms 20,000 and short terms 80,000. That's a problem, right? So the company has to use the net profit of 8 years to pay the short-term debts. That's a financial trouble. Think about you, right? You receive 100,000 per year, okay, and you have short-term debts of 800,000. So, are you going to be able to pay it without selling any asset? Right? Are you going to be able to pay it in the short term? So it indicates a problem. That's why I go here and I check. Let's see this company here. It has zero net long-term debit and short-term here. So I would investigate that. And then if you go here for the top ones, let's go back here, top ones, and you see different numbers here. Long-term debit, 5 short-term. Then you see here 4 years. Then you start checking everything above 2 here. I have to check again. This company here, 5 years in the short term. 5 years in the short term. Let's check this company. So let's see the profile. Manufacturer, automobile suppliers, North is diversified, North America, Europe, Asia. It's international. The sector looks good, but this number here, it's scary. 5 years to pay uh, short-term debts. I don't know. I would not buy this company because of this number here, right? Maybe it has to sell some assets. Maybe the cash flow is weak, and when you have a weak cash flow, you need to sell some assets to pay uh, uh, your short-term liabilities. Then you are going to sell in an urgent way. Then your asset will be sold with a lower price. So I don't like that, right? I don't like that. But that's the idea. Let's go for the next one here. Cash flow and cash flow equivalent per share. That's good, right? Let's say you spend $10 in a share and the company has $12 in cash without any extra assets, without earnings, count one. So perfect, right? That's why I like to check here if the company has some cash, right? Cash per share, right? You see here some companies they almost has nothing per share, just 50 cents. So let's go for that one here. You see she has $83 per share. Let's see the value of the share. 27, right? It's less than 10%. Then now I need to investigate where is this company money here. If it's not in cash, where are they investing, right? So it's better to have more cash. This company, for example, here has 200, but I know this company here, the asset is the shares almost 3,000. So it's 8%, 5%. Okay. I start making this relationship to check if the company has cash or cash equivalent per share. Okay. That's the indication. So to summarize here, and then we create a grade, right? The final grade. Final grade means we put everything together, all the criteria together. If green, right? If this number here, the maximum score is 10. So if it's 5, it's 10, it's 15, it's 10, it's 30, it's 10. All these numbers here, if they reach this number, they have maximum grade, right? If they have this number or lower than this number here, they have maximum grade of 10. If here it's 4, they don't receive a grade like 10. Let me show you an example. Let's go here for another. Let's check another company here. And here you can see how the grades are done. Grow consistent. 4 years instead of 10, you receive 8. Earn variations, pretty bad. 400%, compare it with 30%. So what I do, I discount the amount. Right, the grade per share grow rating 80%. I want 30%. Per share grow 15%. So it receives 10s. Initial rate of return, remember, I want at least 12. It has here 0 per 39. So this number here, that's how I balance them. Here I want 30%, 30%, that's right. So, and depends of how I adjust that, it will have different grades. And then in the end, I have this grade here. Okay. And if I want to know how is the grades calculated, oh, has an error here, but we will fix it. But you click here and you see how the grade is calculated. Okay. Okay. So we have some parameters here. And remember, in the beginning of the presentation, I told you I want to buy companies with the market. Probably it's underestimating. So what I do, I check if the price has decreased around 20% in the last 12 months. From the peak up to now, we have an indication here. You see, this company here has devaluated 20% since the last peak in the 12 months. This company here is 40%, right? This is a small company. That's another thing we're going to talk about. It's a small company here, right? 40% for me is too much. Why the market is devaluating a company 40%, 64%? I think between 20 and 30% is a distortion. Maybe it's a good company, but people are just selling because of a problem, because something has to do with the company in the short term. For example, the negotiations between US and China. Okay, it affects companies. I make I make a good return on this company here. Let me see here. No, wrong stock symbol. See, I make good money on this company here while Trump was fighting with China, and this number here was 30%. 30%. And if you see here the graphic, you see, I bought it this time here and I sold around here. So it creates some distortion. The company looks good. If you see the numbers, it's growing. Variance maybe too high, but it has good numbers here, right? It has good numbers. Total reliability is not so high, so it has good numbers about this company because of a distortion in the market. So that's what I'm looking for, some distortions in the market. The other important point also to check is the market capital. Okay, so if there's a large company, it's difficult to double the size. Of course, Amazon they did it. It's not impossible, but it's harder. For example, let's say Starbucks. Let's say they have 2,000 stores. For them to open more 2,000 stores, it's pretty difficult, right? But if you have a smaller company with 20 stores, for them to open more 40 stores and have 3 times their sale, 3 times the profit, it's a little bit easier, right? So that's why I have this market capital here. You see, I can have an idea about the size, the company size. This is a $1 billion company. This is a 300 million. This is a 7 billion. This is a 19 billion. So that's a 20 billion. So for this company here, for example, of 300 million to become 1 billion, right? And his stock grow. It's of course it's not only that. If you see here, we are expecting 250% gain of capital in the next 5 years. So what we are saying here, this company will be almost 1 billion, right? Then we need to analyze the other numbers here. This is my watch list. I'm watching these companies here, different sectors. Okay. So basically, that's the concept behind the website. If you have any questions, send us an email. But the concept here is to help you to find good companies, or to validate your ideas, or to find companies to investigate more, right? For no subscribers, we have these 3 stocks, 1 stock here. And for you as a subscriber, you also have these hot companies here. Hot companies are companies which have the good numbers. So you see here companies that have solid numbers and good share prices. There are some parameters to show good share prices. And these are the ones I'm waiting. I'm paying attention. This watch list is the one I create manually. This here, the software created by itself. So this company here, for example, 5 years growing, nice. Early variations, not a roller coaster, 30%, good. Per share growing, grow rate, okay. Annually, 12%, looks good. Almost 12. Initial rate of return, you see, low. It's 6% to be the minimum. So maybe in the next market correction, or if some bad news affect the market, maybe it's time to buy. Return on shareholder equities, 31%. So it's a good number too. Expected percent capital gain in 5 years, 72%. I like it. Bond, you see, 80%. It's almost good to buy. Price to earnings ratio, a little bit. Need to wait. So you see, I have 3 or 4 indications here. I need to wait. Research net income. Here I need to investigate. Why this company is not investing in research and development? right? Is this product really good, or this number here, or they are paying somebody to research and development, or how they keep their durable competitive advantage. They are buying back the stocks, pretty nice, you see. They are buying back the stocks. Their liabilities are not so high, and they have cash here. Let's see the percentage of cash compared with their share. $4, a little bit above 6%, almost 7-10%, between 7 and 10%. But you see, there is no correction in the price. They are trading at peak level here. So maybe if it reduces 10%, I'll have some corrections here, and then it will be time to buy the stock, right? Let's go for the same thing here. 33% annual variance, growing every year, per share grow, initial rate of return, return on shareholder equity, expect capital gain, almost the same numbers. You see? Almost the same. The only difference here is less aggressive to buy stocks back. And you see here, 10% from the peak. So if it goes less 10% here, maybe it's time to buy. And then it goes up here. And then you can check and buy. The same thing here. So, and you have a lot of things to do here. You can go here. You can check top companies and you can analyze them. I do that. I enter here, I go one by one. I check it and I learn it. Now you know the concepts, right? Just to go back here for the concept, right? So what do we analyze? Grow consistent. Is the company growing? Earning variance. Is a roller coaster or it's predictable? Per share growth rate. Is growing fast or slow? Initial rate of return. Is it around 12%, lower or higher, right? Return on shareholder equities. The money I'm investing. How much return I'm getting? Expected capital gain in 5 years. Based on the past, how I project the future. Okay, is it above 80%? Bond coupon percentage. How do I compare with the treasury bonds? If I invest in the U.S. government, I have less risk if I invest in a company. So I want a return of 4% above of the treasury bond. Price to earning ratios. How many years of earnings we will recover my initial investment? $100, $10 earnings total for the $100. It will take 10 years, right? Research and development net income ratio, research and development revenues ratio. Are they investing a lot of research and development to keep their durable competitive advantage, or they don't need to invest a lot? Do you remember Starbucks against Boeing? Starbucks are banned, Tesla, for example, right? They need to invest a lot of money, Airbus, Tesla, to keep their competitive advantage. Starbucks, maybe they don't need to invest a lot because coffee is not something they need to recreate every day, right? Again here, net income or purchase stock ratio, revenues or purchase stock ratio. Are they rebuying their repurchase stocks? You remember the example, 4 partners, you and I, plus 2 ones. If the company goes and buy the parts of the other 2, we used to have 25%, now we have 50% without spending more money. The company, because the company is good, they're rebuying repurchase stock. The other thing is, if the company has a good business, why he's going to do something else? If I have a good business, I'm going to reinvest in my business, right? Also, the liabilities, total liabilities, long-term liabilities, short-term liabilities. If the company has cash and cash equivalents per share, the final grade, it's summing up everything here and balancing everything here. Percentual loss from the peak, right? If it has some bad news which is affecting the stock price, maybe the company is good, but it's just a momentary problem, right? For example, this case about this negotiation between Trump and China, it can affect the stock, but it's a good company. It's going to recover. It's just the market. It's underestimating the value of the company and the market capital, because large companies will have a harder time to duplicate his size. Think about Apple, a $1 trillion company. Imagine the Apple to duplicate his size. It will be hard, right? Have to open much more store. Have to create new products. It's hard. And then a company a small company or a medium-sized company, right? It's much easier for them to duplicate their size, so the stock is going to grow. It's much easier for them to expand. Some companies they are very saturated. It's difficult. So that's it for the moment. I hope you enjoyed the video. If you have any questions, send us an email. But that's the idea. It's to make you analyze companies quicker and easier, help you to make good investment. I have lost money investing in bad companies without doing my research. I like to invest in good companies. I think it's a win-win situation because you are spending your money to invest in good companies, or I mean, you are putting your money in good investments. You are motivating the managers because the managers of the good company see the stocks are going higher, and instead of investing in companies where they are not so good and the financial numbers are not so good, and then you may lose your money, or as I did in 2002, or in the long term you don't have capital gain. So there's a lot of that's why it's good to invest in good companies. It's a win-win situation for everybody, and also to validate, to find, and also to find this distortion in the market where you can find good deals, right? Some Warren Buffett says better to pay a fair price in a good company than a good price in a bad company, right? And also we are talking to be here about long-term investment, plus years, or as Warren Buffett did, 50 years or more. So thank you very much. If you have any questions, please send us an email.